Okay, so welcome back to the podcast, everyone. And today's guest is Candace Crawford, who is a real estate investor in single family, multifamily. She also runs a landscaping business. She's an artist, a true entrepreneur. She's in so many different things. And just like me, she's a podcaster as well. So I'm very happy to have her here, and maybe one day I'll be a guest on her podcast. Okay, so welcome, Candace. Anything else you want to add to your intro there?
No, I think that's perfect, Zach. Thank you so much for having me on.
Okay, great. So let's jump into some questions. So the first question I always like to ask is, how did you get into real estate? What inspired you, and what was the aha moment, or like where like a light bulb went off in your head, and you decided to maybe focus on multifamily, if that's what you did. Okay.
Right, sure. So, you know, it real estate came into my life by default. I live on Cape Cod, Massachusetts, and there's a housing crisis here,
Mm-hmm.
even more so. In 1992, it started to happen with vacation rentals. We're taking over the small homes that were being, turned that were apartments. They were being chopped up into condos and as vacation rentals.
Yep.
Fast forward, I couldn't find a place to live, and I needed a home over, house to live in, and I wanted to stay here. So I happened to have already gotten, just through my landscaping business, I was doing lots of little handy projects, and I got my construction supervisor's license.
Okay.
So it ended up being cheaper for me to actually purchase land and build my own home, which has always been a dream.
Yeah.
And that is what got me into real estate. It was my test home to see, did I want to stick with landscaping, or did I want to become a builder? And I'll be honest with you, Zach, I grew up on a farm. I'm an outdoor person. And
Mm-hmm.
when you're building, you're inside looking out. And I was like, for me, and I hope that other people, just to inspire them as well, our listeners, I wanted to be happy doing
Yep.
what I was doing, my business. And so that's why I chose landscaping as my career. But in the interim, within a short, 6 months, I did not know, I had no idea about the power of real estate. I never
Mm-hmm.
grew up on a farm. We never talked about investments.
Yep.
You work until you die.
Yeah.
And that's when I learned the value of real estate and appreciation, because
Mm-hmm.
obviously when you do ground up, you have appreciation very quickly. And I'm in an area that has appreciated to just an astronomical cost. It's
Yep.
luxury homes here. And that's how I saw, ooh, this is interesting. And so I did it as a hobby, as
Mm-hmm.
a buying fix and flips and doing things like that as a hobby. Then I moved forward into seeing the need. I started doing lease to own purchasing.
Okay.
And with that, I found I had a huge buyer's list,
Mm-hmm.
but I didn't have many homes, and it takes a while to get lease to own in an area where I live. It
Yep.
took about 6 months to get one house.
Yeah. Okay.
So I fast forward, I was like, I'm listening to a lot of podcasts, and I'm picking, oh, what is this multifamily, multiple doors under one
Under one
roof?
roof. Uh-huh.
You make money faster. And I thought, well, that way I could do my landscaping, I could do the multifamily, I could bring that as my income in, and then buy more single family and hold the notes for the single families. And
Mm-hmm.
that was my business plan. Well, once I got into the multifamily, that's when I started to realize that it really, as a general partner, you don't get paid. If it's a large syndication, I will add, you
Yep.
don't usually get paid for a year, sometimes to the end of the business plan.
Yes,
So
yes,
it
yes.
halted my single family business. And so that's what got me on the journey from and rapidly moving into real estate, but also pivoting again and coming back to single family,
Mm-hmm.
using the knowledge that I have through syndication. For those that don't understand syndication, that is just simply raising money from private investors to come in and help purchase a property.
Yep.
So with that, I was like, I could do the same thing and find private money lenders for my single family homes.
Mm-hmm.
And so I'm still doing both,
Yep.
but I'm still focusing back on and helping with the housing crisis and the exact same thing that happened to me.
Yep. Okay. Okay. All right. So it seems like there's a lot to unpack there. I actually have a few follow-up questions. Um, so so you're back to doing single family again. You're still doing multifamily, but you're kind of using what you learned from the syndication aspect, the kind of like the team sport aspect of multifamily, and you're applying that to single family now. Is that kind of correct? Kind of a good summary there?
Absolutely.
Okay,
Yes.
okay.
Yes,
Very
definitely.
interesting, very interesting. I think we're actually on we're actually on a similar path because I like a lot of the stuff that I've learned in the syndication space, and I think that can be applied in other areas that I never thought about before. So yeah, I kind of think we're on kind of on a similar trajectory there. Maybe not exactly like 100%, not exactly 100% the same, but quite similar. Okay.
Yes. And if I could add to that, Zach, is that
Sure.
the difference for people are like, well, what is the difference? The difference is that people that have invested in multifamily that do it on a regular basis, they're used to specific returns. They're used
Mm-hmm.
to like a 2x multiple, meaning usually, not always, depends on the market and the property, usually get twice your investment back plus interest for the duration of the 5 to 7 year business plan. Right
Yep.
now, some people are doing 3 year business plans because of the market. When
Mm-hmm.
you go into single family, the funds usually are returned much quicker.
Yep.
It's usually if like for a fix and flip, it's within 6 to 8 months.
Mm-hmm.
So those are the differences in case the audience is kind of like, well, what is a little bit different? And those people that are lending in the private sector of private money lenders, they tend to have more of an ongoing relationship with the individual,
Yes.
including also looking at obviously the numbers of the property have to count, but really with multifamily, you're looking at the team as a whole, but you're really looking at how that property and that business plan is laid out and is that realistic for the area.
Yeah, yeah, yeah. Okay, so it's it's like I said, we're on a very similar path there. I'm also in the process of actually starting like a joint venture fix and flip kind of thing. Maybe we can talk about that a little bit more later on.
Yeah, yeah.
Anyway, okay, so can you walk us through your first multifamily deal, and don't leave anything out. I want to hear the good, the
Sure.
bad, the ugly, everything. Yeah.
Oh, I will. And one thing I'll tell you is that you'll hear a lot, you'll see people. The great thing about social media is that you kind of see what really is happening and the trends. And the
Yep.
bad thing about social media is that you rarely see anyone posting, oh my
Oh, the
gosh,
bad
or
things,
going
right?
south,
Yeah,
or
yeah, yeah.
property management just made our deal turn south. I mean, you never hear that kind of stuff.
Yeah, it's just kind of like the highlight reel, right? You only see the good plays, the good things, and you don't really get to, see the nitty-gritty sometimes. But okay, so let's hear it from you.
Okay, so my first multifamily, it's in Houston, Texas.
Hmm.
It's 134 units, and I got invited to be a part of the syndication team on that. And the operators are phenomenal. I've created a relationship with the key principal. These are the people that sign the loan and
Hmm.
really are the ones that run the property. I've had a relationship with them, built a relationship for quite some time, maybe about a year, I think,
Okay.
before I was even invited to come to that. And that's a key component right there, is to really
Hmm.
know who your partners are that you're getting in with. So I felt confident that with the experience, one of the women on the team, she actually has her own property management company for
Okay.
30 years doing large multifamily. So they were running the property management. So I felt confident that the deal could move forward very smoothly instead
Right.
of being a lot of new people or understanding what was going on. So that property it's struggling, I'll be honest with you, because just like in single family, you may get a mortgage with a company, with a bank, and expect that's the person you're doing transactions with. Well, what
Hmm.
people forget or don't realize is that even on the large multifamily scale, banks are always starting notes and then they sell them to
Exactly. Yeah.
continue cash flow. And that really affected our deal because and there is a clause. I'm just going to say this for all you
Hmm.
multifamily people out there. There is a clause that's in pretty much every multifamily loan document that says at any time if you haven't drawn money from a construction loan after a certain amount of time, which is usually, not always, depends on the contract, a year,
Uh-huh.
if you haven't done that, they will charge you interest on money that you've never received.
Okay.
When you're looking at a large multifamily of 100 units, that could be easily $35,000 extra per month
Yep.
when you think about it. So what happened for us is that they sold the construction loan, and it was really that part was fine, but we were in the middle of a draw, which is
Yep.
for those listening, knowing that if you get a construction loan, they pay you, but they have to inspect the amount of work. They have a list of what things can be checked off before you
Before they
pay
give you exactly. Yeah.
anything. So with that being said, um, we didn't have the original inspector before. We had a new
Hmm.
bank, but the new bank bought a very large portfolio. So they weren't just going to come out and inspect. They said, we have to look through our portfolio before we can come out. Now, meanwhile, we've been implementing our business plan,
Right.
and everything was going beautifully, smoothly until the bank
Uh-huh.
stopped the payment.
Yep.
Isn't that interesting? Everything we're doing right, and the bank stops the payment. Not just stops it, but they stopped distributing any funds, not for any reason of what us not doing the work,
Yep.
because they weren't finished looking through what they bought.
Right.
So I think it was like 8 weeks went by before they had an inspector come by.
Oh
And
my
then it was
goodness. Uh-huh.
3 weeks to start getting funds coming back in. That slows a project down. That
For
slows down
sure.
the business plan. And when you have a business plan anywhere from 5 to 7 years, that it greatly affects your numbers because you're expecting to have revenue coming in at a certain point to start, that you've projected so that you can give that money to your investors.
Yep.
And then, we had a little bit of the market shift because of the bridge loans. So there was multiple things that were compounding on this deal. And that's what happened. And it was just so frustrating because legally, yes, they could do that. And
Hmm.
then what it ended up doing, fast forward, put us past the 1 year mark where if you haven't drawn from your construction loan, we're going to start charging you interest.
Yep.
Then they applied that clause.
Hmm.
So now we're not finished with our construction. We're not up to our business plan where we wanted to be. And now you're adding another, over 35 grand onto our expenses per
Yep.
month, just setting us up for failure. And it was so,
Exactly. Uh-huh.
yeah. So that's where we are right now. But we've been working with the bank, restructuring what loan we have and working, and they're willing to work with us
Hmm.
to try to see if we can bring this business plan back around. And it's unfortunate because honestly, I personally feel that 65% of that error that's going on with the business plan
Hmm.
is because of the bank, and the
Yeah. Yeah.
bank is
Yeah.
a partner. So that's what's happening with this deal. And it's a very frustrating thing because your hands are tied.
Yep.
They kind of are the boss in that, and they have every legal right. And I don't know if you could actually ask for those clauses to be removed from a loan application document.
Yeah.
I
You,
probably would
I,
now in the future.
you can ask, but I think most banks will be like, nope, these are our terms, so it's either like take it or leave it. Yeah, I've heard of different clauses before, but not this one. So that's something I think a lot of people don't read these documents, but I think even if it's super long, at least take it to your lawyer and you try to at least read everything as well. Yeah, there's
Yeah,
definitely some lessons to be learned there though.
yeah,
Okay.
yeah.
How has your strategy like evolved since that first deal? So for example, maybe like deal criteria, has it changed since the first deal?
Well, yes and no. So when I got into the second deal, I started to notice that, as a general partner, you may not necessarily, the reason for me, like I said before, getting into multifamily was to be able to have that acquisition fee and
Hmm.
then fund my single family business.
Yep.
Well, with a business plan that's a value add in particular, you usually don't get paid for the first year, 2 years, depending on the business plan.
Yep.
So I was like, oh, so now I'm working for free,
Hmm.
really.
Hmm.
Um, I have to put this other business on somewhat on hold because I've already allocated my funds to, I don't have any more funds. I was hoping to refund and just kind of snowball and keep and recycle. So let me see in this multifamily world, it has potential. What can I do next in the next position
Yep.
to bring about cash flow? And that was earnest money deposit. And
Mm-hmm.
that's what I got some other people in our mentorship group together, and we created an LLC that would provide the earnest money
Okay.
to go to the next deal. And that's a high risk. And I will
Yeah,
say
yeah,
this
yeah,
to
exactly.
anyone out there, it's high risk. You need to know, again, your team. You need to really know that that property, like, there's always a chance the property won't close for whatever reason. Due diligence period, but at a certain point, then that earnest money deposit needs to be in the account.
Yep.
So don't put all of your savings or anything like that into an earnest money deal to try
Mm-hmm.
to get money because it's high risk, but usually the earnest money gets returned right after you close.
Right, right, right. Well,
Which is
there's a
great.
reason there's a reason it's called at-risk capital, right? So
Yes, and here's the thing. At-risk capital is you put your money in
hmm
and you're taking that risk because you're getting a portion of the deal just for doing that particular position
Yep.
without having to do any other roles, really. I mean, you
Yep.
do want to have other participate in other roles because then you get paid more,
Yep.
but be part of that GP team. But there are people that just do that. And
Yep.
then that's perfectly legal to do that. Now, the thing is that you get that money returned, you want to rinse and repeat. You want to do that again.
hmm
So that's how I did it. So that money came back, and that was good because then I took that money and allocated that into a single family,
Yep.
can continue my single family business. So then I was like, okay, so I'm not going to be paid by this, which I know now from my first deal. I'm not going to be paid until we get to a certain place in the second deal, which is 100 units in Texas.
hmm
So let me take those funds that I use for earnest money and let me put those back into my single family and
Yep.
continue that business, but moving it slower than what I normally would like.
Okay. All right. And how about like, a lot of people before the first deal, they have one kind of mindset, and then after the first deal, they have like a dramatic mindset shift. How about for you? Did your mindset change after the first deal?
Well, the level of confidence was one thing.
Yeah.
Attending, those property management meetings, for me, the aha was this, that I did not give myself credit for the amount of information that I really know. I
hmm
kept my mouth quiet, thinking that I'm, very new at this. I have nothing to offer, and that is not the case at all.
Yeah.
And a good portion of that is one, I'm a contractor. The other one is that with my landscaping business, I'm in, luxury A-class properties that I
hmm
maintain the landscape for. And with that, I tend to be, because I have a contractor's license, I either do some minor repairs for my clients on their homes or managing. And
hmm
I do a lot of property management for Class A clients.
Yep.
Well, it's the same thing except multifamily. It's just, well, not all multifamilies under one roof. It's the same thing. So
Yep.
there was a lot of things that I know as being, a general contractor on a property, things to look for, like you always measure the door width before you get the appliance to make sure it can get in the front door.
Yeah.
These types of things.
Yeah.
You
Yeah.
know, one of the things, and I heard about this and it kind of clicked a little bit more because there's condos here, obviously, where I live, as I talked about the housing crisis. Sometimes they'll have more than one general contractor on a complex to get it on the market faster.
Okay.
And so one contractor will just frame out the doors and put the doors in. The other contractor will look at the plans, measure out the door, order the right doors, where the other one just ordered door maybe 2 inches smaller.
Yep.
So you have to take those kinds of things into consideration. It's like, okay, appliances for both units. Oops.
Mm.
The second one, the appliance is not getting through the door. We have to take the whole frame off or
Yeah.
order a new appliance. Same thing goes for the multifamilies, is that never think you're going to order all of your appliances or something and put them in storage early make sure you go through each individual unit where you're going to be doing the construction, if any, to
Yep.
put in, say, a washer, dryer, or new stoves, and make sure it can fit through every door. Because that was one of the things on the first deal, that they had one building, everything went smoothly. They opened up walls to see, make sure there weren't any surprises. Great, nothing, everything's going well. Went
Yep.
to the second building that looked exactly like it, opened up the wall. Wait a minute, the plumbing for the washer and dryer is not here. What'd they
Uh-huh.
do with this one?
Yeah,
So all those sort of things you have to take in consideration when you move forward.
for sure, for sure. Hey, if you've got a real estate deal, a problem, or even just a question, we want to hear about it. Doesn't matter if it's big, small, complicated, ugly, or somewhere in between. If it's a good deal, we're absolutely interested. Period. And if you've got capital, you need to put to work in solid real estate opportunities. We've got those too. Either way, let's talk. Here's how this works. We always need more deals. We always need more capital. And we always find a way to make it happen. No games, no runaround. If we can't work together directly, we'll hand deliver you to someone who can. Okay. And then let's look into like some tips and pitfalls. So what are your biggest lessons around, let's say, finding deals?
We are at the, if you're coming into this new, we are at the bottom of the pond. We're the bottom feeders.
Mm-hmm.
If you think about any real estate in general, the real estate agents, including the brokers for the large multifamilies, they already have a list of people. They make money when they close. They make
Yep.
money when they connect with people that they know can bring something to close. And what they'll do when something gets, before they call it off market,
Mm-hmm.
and they'll call up, they'll say, to the broker, tell us what you think we'll get for this property. They'll tell them, and then they'll call the people on their list and say, this is an off-market deal. There's no pretty pamphlet, no PDF, no, nothing has been made. They'll share information, and then if those people are interested, then they'll start the conversation and do everything behind the scenes, and boom, that
Yep.
property's sold.
Yep. Yep.
If
Before
those
it hits the
people,
market. Uh-huh.
yeah, and then there's several layers that particular deal will be offered before they even make an offering package to show
Mm-hmm.
anyone. Once it hits the MLS and any of those multifamily sites, it's already been picked through and sifted through.
Yep.
So finding a deal as being someone new is a very difficult thing because you're not the person that they call immediately. So
Exactly.
you
Uh-huh.
but underwriting all those deals is not a waste of time. It's really important to underwrite those deals, understand it. So then when you're looking through, because there are also times that good properties are listed on LoopNet or Crexy that have just been passed over
Exactly.
because
Yep.
everyone assumes the same. So it doesn't mean that there aren't gems hidden there, but it's not something that you're going to find a deal overnight.
Yeah, you
It
need to
can
look
take
a little
6
bit
months to a
harder.
year.
Yeah.
Yes. And you have to be able to move fast in putting in your offer, which means you have to have your lender, your insurance quote, everybody working with you as soon as possible to get that offer in
Mm-hmm.
to get it.
Yep. Okay. And then what about your and any lessons around, operating and actually executing on a deal or like a plan after you get an offer accepted and everything?
Yeah, one thing I just want to add quickly to the previous question,
Uh-huh.
and this is something that is not understood. When you think about if you go to get a loan for a car, every single person is different when you're
Mm-hmm.
given a quote.
Yes.
Um, Often it's taught that you can just throw in 5%. I'm making up numbers now, I have no idea
Uh-huh.
what it is right now.
Yeah.
Throw in 5%, underwrite it at 3, at the time when things were going down, underwrite it at 7.25. And if you call up a broker and they give you a number to punch in, you really don't want to do business with them. And the
Mm-hmm.
reason is that it depends on who the sponsors are.
Yep.
The lender, the broker is going to underwrite that property as well, not just
Yes.
you. They're
Yep.
going to look at yours, but they're going to do their own underwriting, and then they're going to say, "Hey, you know what? You put in a too high of an interest rate. we can go lower on this one. We go Freddie or Fannie, which is
Hmm.
the government
Yep.
loan
Yep.
application. So you need to have a broker on your team that you send your underwriting to, that then gives you a rate for your property that you then submit to your LOI. Because there are people that underwrite, throw in a number, they get their LOI submitted, then they go to get the loan or at
And
least the quote,
uh
and the
numbers don't
deal
come
doesn't
back the
work
same.
anymore.
Yep. Yep. Yep.
Yeah,
Yep. Okay.
yeah.
Um, so how about any advice about exiting a deal?
Well, one thing that we're not really taught, and it totally makes sense, is that you're forever, it doesn't finish, you're not finished evaluating the surrounding areas and the comps and the performance of the property that you have. Because in a large syndication, you're constantly underwriting the deal to make sure you're on track
Yep.
to meet the expectations that you have presented to your investors.
Hmm.
So you're looking at what the market is doing. Like for instance, everybody was like, "Oh, we can up the rents X amount of dollars per month, and this and that." And a couple of things to think about when you are renting a house or just having a mortgage. You, you don't just like you don't want to stay in a place if someone is suddenly going to increase your rent by $100,
Yeah.
10, 15, 30, maybe, but it's pushing it, you know?
Hmm. Hmm.
Unless you're providing something dramatic that's changing the existence of the property, like, oh, we're going to raise it $50, but we're putting in a brand new pool. Well,
Yeah.
people might say, hey, we
That
like
works.
that.
Yeah.
But just for the sake, because you painted and you're going to increase $50, that doesn't work. And so you have turnover. And
Hmm.
the more every time you have turnover, it means you have to go back in, you have to repaint that apartment. You have to maybe fix something, maybe the appliance, they broke a refrigerator, who knows why or how,
Hmm.
but that happens.
Yep.
So the more you can keep someone in your apartment complexes, the more money you actually make because it costs a lot just to do a simple turnover.
Yeah.
So the exit strategy is forever changing in the sense you have a general idea that yes, in 5 years we want to sell, but you also have to see what is the market bearing?
Hmm.
What are these properties selling for at this time? Now that doesn't mean that every 6 months you have to like look at the properties in the area. In this market, if you're getting close to your business plan, you do need to start really paying attention. Right, this place down the street sold. What did they sell for the door? They look very similar to what we have.
Yep.
Are they comparable to what we were expecting? And so it's always evaluating, continuing. It's not evaluate once and done. It's a
Yep.
continuation of the whole thing,
Yes.
including
Agreed.
rent, including
Yeah. Yeah.
rent.
Yeah. For sure. For sure. And I've also heard that, yeah, like, turn, like when you have to turn over units, I've heard that that's usually like the most, like the biggest expense actually. So you want to keep that down. You want to minimize that as much as possible. Um,
Yeah. Yes.
okay. All right. So let's go over to the rapid fire round. And just
Okay.
tell me the first thing that comes to mind. Sorry. So the first question is, what is your worst tenant story?
My personal tenant story. It wasn't in a multifamily.
Sure. Sure. No problem. Uh-huh.
I had a I had uh I had my house. This was a house in Indiana that I was holding the note for, and it's higher return, but it's higher
Hmm.
risk because it's
Yep.
people that normally do not get approved by banks. They might be on disability, Social Security, but they want to own a home.
Right.
I had I had a contract for deed, and the people had some addiction issues,
Hmm.
and desperate for money, and they stripped the house, uh,
Oh.
like trying to even get the copper wire out in
Oh my
order
goodness.
to pay for their habit. Unbelievable to the extent where this particular client, I don't quite understand this. I think it's because they didn't pay their water bill.
Hmm.
So the water department turned the water off. They had no plumbing. So instead of paying for the water to come back on, they removed the toilet and busted a hole in the floor, and it
Oh.
became a potty.
Oh my goodness. Okay, sorry, sorry. Sorry to laugh, but
Unbelievable. Listen, you
Yeah,
survive. People are like, you survive.
yeah,
You find ways to you reevaluate now what is the value of this property, but it's still sellable to somebody
yeah.
that has the know-how to fix something like that.
Sure, sure, sure. Okay. How about like your favorite expense saving hack?
Favorite expense saving hack. Well, I gotta say, doing what I do with a single family
Hmm.
is holding the note.
Yep.
I mean, basically what I'm doing, it's not, I haven't like transferred title, but I'm holding, it's an installment contract. Because I'm not responsible for the property, but I am receiving a monthly income
Hmm.
and just being the bank. I mean, think about it. The banks really, for the most part, well, they're their biggest partner in any of these multifamily deals if you have leverage.
Yep.
And they're the ones that make the most, and they're the ones that run the shots.
Yes.
And listen, I've been my own contractor for, my contracting business for, 33 years now. I will say, without ego, I like being the boss. So, and on a multifamily, obviously, this was a challenge as well.
Hmm.
When being in business for myself for 33 years, it's very easy for me to make a decision, move forward, correct, pivot. But when in multifamily, you're now dealing with people that you are one coming in new, you really have no voice. So
Yes.
you have to just become basically almost like a W-2 worker, which
Hmm.
is really hard for me. And also working with people that might be, part of your LLC, please make sure that you get along well
With
with
them.
them and that they don't run when you get into difficult times. Everybody's happy when they have money coming in,
Yep.
but make something uncomfortable to talk about before you partner with someone. Don't just Money does not mean somebody is a good partner.
Hmm.
Even if it means their connections to money does not make them a good partner because they can disappear on you and you could be holding the bag for
Yep.
everything.
Yep. Okay. How about, so there's like a lot of advice floating around in the real estate world. What do you think is some of the most overrated advice with respect to real estate?
Overrated is joining multifamily and suddenly getting the acquisition fee and quit your job and burn your ships.
Yeah.
I think that's completely false. I understand the concept of being paralyzed by analysis paralysis and fear of missing out. Don't get
Hmm.
me wrong on any of that. Show me someone that really operates well under stress. You
Hmm.
do not, your brain, the wiring, it doesn't even work effectively. So
Yep.
if you quit your job and then try to get into another business that you don't even know that well,
Understand perfectly. Yeah, exactly. Uh-huh.
that doesn't make sense to me at all. And I just really am bummed out by the number of people out there. I'm just going to call them gurus that just say, "Look at me and my big fancy car."
Yeah.
Is that happiness to you? What is your and with that I'll say, and this is why I started my podcast, is what is your financial freedom? Is it a number or is it a lifestyle? Is
Hmm.
it time? What is your financial freedom? Because a lot of it's really easy to be, and society teaches us to be consumers,
Hmm.
to think, oh, if I have this, then that. But most of the time, it's like, if I have time, that's what they're looking for is time to
Yep. Yep.
do
Yep. I
do
agree. I
things.
agree. Time is the it's the best thing to have. And it's actually the most it's the thing that actually most people really want. It's more time to do, things that actually matter to them and so on. Okay. So then conversely, how about any advice that you think is underrated?
Underrated. Hmm. That's a good question. Well, I think it's underrated in the partnerships. I think it's glazed over.
Hmm.
The realistic, the business plan and the business plan of understanding that any business takes, like, to really see it as being a productive business, to know if you're going to really hold your own, takes about 2 to 3 years.
Yep.
And I don't think that that is really taught. I think that multifamily is an awesome asset to own.
Hmm.
If you want instant cash flow and really want to start making money with multifamily, don't go the large apartment syndication.
Hmm.
go joint venture, or buy smaller properties.
Yeah, yeah,
Start
yeah.
with and the other thing is that you can't just go in to multifamily and say, "Hey, I have the money. I'm just going to buy, a commercial property, which is five, five doors and up is commercial."
Hmm.
Even if I had like cash to buy one, to put a down payment, a bank wouldn't loan to me because I don't have the experience of
Yep.
being a multifamily owner for 2 years. So you need to own something small that's multifamily to show that you know how to do it before you can buy a larger one. But if
Hmm.
you joint venture, that cash flow that comes in, if it's managed properly, that's where you can create financial freedom.
Okay, so yeah, I think the team that you work with is very important for sure. Um, and so the next question, like in the Warrior Group, we like to talk a lot about superpowers. So what do you think is your superpower or your unfair advantage?
You know, I'm a Jane of many trades, a master of none. That
Hmm.
that is a superpower in itself because I may not necessarily know, or be as fast as say at underwriting, but I do have an engineering mind.
Yep.
So I can see the numbers and understand them. It may take me maybe 2 more hours than it would that someone is just like spreadsheet savvy to be
Hmm.
able to throw the numbers in and just loves playing with those. But I can understand them and see them and ask, what this is just here, just there. I've learned over the time being in these two larger multifamily units, and I'm a limited partner in a smaller one, a 38 unit in Georgia,
Hmm.
which I have to say I love being a limited partner because I just get updates.
You
I don't
get you
have to
yeah
attend.
you get all the rewards without all the headache and everything. I think sorry, okay, sorry to
Yeah.
cut you off. Yeah, I know what you mean. I know what you mean.
No,
Yeah.
no, yeah, no, it's very organic. Yeah, I totally love it. I see
Hmm.
why people want to do it
Yeah.
because I'm like, and I see people that have been limited partners for years and like, I'm going to come in and get more of the pie. And I'm thinking, you have no idea what you're just jumping into.
Yeah.
It's another business. It's a business. It's not like, I'm just going to show up for an hour. It's not that at
Yeah,
all.
yeah. Sorry, go ahead, go ahead.
So because I did so much property management with my landscaping business with my clients, asset management, thinking outside the box, just being an artist. I think outside the box all the time,
Hmm.
and that is my superpower is to be able to problem solve.
Okay.
And that is something that once a property gets under contract and moving forward, all right, how are we going to do X, Y, and Z? I can see that very quickly just by the way that my brain operates.
Yeah.
So that's my superpower, I would say.
Okay, okay. That's a good one. A problem solver is definitely being a problem solver is definitely a good superpower to have if you ask me. So I don't like to use the word like, regret, but if you could go back, is there anything that can you tell me one thing that you might do differently?
I was not aware that you could do private money lending for single family because I never was in that world. I
Hmm.
was just did my own thing with my own money. And because of what I do with the houses that I sell on contract for deed, I really feel like that it has an impact. Not only does it have an impact on people's lives, but I think it has an impact on the housing crisis that we have. There's so
Hmm.
many houses that are vacant, um, or on the market for a long time because people can't get the loans to buy them.
Yeah.
And I regret not being able to know that. And because of where I live, I'm 2.5 hours from a real estate meetup.
Hmm.
Zoom opened my world into such a beautiful thing.
Yeah.
I would have preferred to have taken my energy and created a private money lender network as opposed to an multifamily investor network. They're
Yeah.
completely different. It's like apples and oranges. So in a way, I feel like I'm starting over a little bit,
Yep.
but I have a lot of experience to bring to the table. So it's really not a bad thing at all. But I would have preferred, I like to have more of a direct impact on people's lives, more of a
Yep.
one-on-one kind of person. And that's, if any regret, it was that, just not having that knowledge. But it was nothing wrong with the path that I took.
Yeah. 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 Anyway, in any case, a lot of people like to say like the all the choices that you previously made led you to who you are today. And if you go back and change something, who knows what else would have changed in the process. So you're here today, and I think you're happy with where you are. So okay, great. That's why I said I don't like to use the word regret, but it's just a question I like to ask anyway. All right.
Yeah.
Last question. What do you think? What's your best advice for new investors? And let's categorize this in two different ways. So the first category is like active investors, and the second one will be just passive investors who maybe they want to get into deals as LPs or whatever else. So what's your best advice for active investors first?
For active investors, my best advice is know your team. Build your team, and your team isn't just the people that you're looking at properties and underwriting them with. You want to have your attorney picked out. You want to have the conversation with that attorney. You want to have your loan broker stick with one. This is a small world,
Mm-hmm.
and you really need to pick your team and stick with them and go through the grind of here we are. We got another deal. We didn't get best and final. Next, you just have to keep moving forward. And if you move forward, you're taking baby steps. It's what is the saying? How do you eat an elephant one bite at a time? It's
Mm-hmm.
very much like that. Multifamily is not a race, nor
Yep.
is any business. No business is a race. So think of it, you're just starting it as a brand new coffee shop that opened up on the corner that has no advertising.
Mm-hmm.
How are you going to get the customers in? You're going to do it by learning the environment, learning what people need, what people want, and your market.
Yep.
And stay away from the fear of missing out. Just curb that in and put the blinders on and focus on no more than two markets. And the only
Mm-hmm.
reason I say two is that you could have another team member focusing on one and you're underwriting deals in two markets. But otherwise, you're just spreading yourself too thin.
Mm-hmm. Mm-hmm. Yeah. Okay. And then how about for new investors who just want to, they want to invest in other people's deals, or they don't want to be active? What's your best advice for them?
I would say, first of all, you again know your team. What
Mm-hmm.
is their history? What is their track record? I will provide, I don't know off the top of my head, so I will not say it out loud.
Okay.
I was on a meetup, and there is a gentleman who has created a website for passive investors and it's for free. You
Mm-hmm.
can type in the name of the
Yes.
investment group.
I know this. I know this. I forgot the name of. I know which one you're talking
It's
about.
really simple. I
Yeah,
know, but
yeah,
I
yeah.
can't remember.
This.
We'll make sure that we have this
I'll
somewhere in
probably
the
drop
show
it
notes.
in. Yeah, exactly. Yeah. I'll drop it in the
And
in
it's,
the in the video editing. Sorry. Go ahead.
yeah, because it's really incredible because you can see what deals they have, what deals they've closed, how they performed in the sense like, if there was anything negative that happened, having a track record because people can talk. Listen, you can create numbers to say anything.
Exactly.
Know the market that you're looking at to invest in. As a limited partner, you still need to have your own due diligence on your own because yes, these are great returns and potential great returns on these properties. But you need to know the market. Is it realistic what they're trying to project to have the rents raised? Is it realistic for this market to have so much housing? You really is what is the growth of
Hmm.
the job? Who's there? Is it a one horse town, meaning just one big factory like what happened to Detroit?
Hmm.
All of the things. And just because it's the military does not mean it's a great place to invest.
Exactly.
So, what kind of investment is it? Is it student housing? Is it because there's so many, you say multifamily, that is almost like an umbrella. Like when
Yep.
you say, I have insurance. Well, what kind of insurance? There's so many types out there. Pick a certain one or two, maybe learn about that, and then really investigate the people that you're going to be giving your money to. There have been a lot of people, myself included, that jumped into this, and a lot of people had a lot of money that were
Hmm.
able to do this without experience with
Yep.
some, and those people have crumbled, which have given us a really bad name for those that are just going along just as you're supposed to be doing.
Yep.
So really need to know who you are investing with. Go to meetups that are, you can do lots of online meetups. There's Julianne Peterson's Zoom at 8. We'll put
Hmm.
that in here. She's a broker, but she brings multifamily investors, general partners, accountants. She has, cost segregation. She has everybody that comes in and we all talk and have breakout rooms. Attend those. Find out who do you continue to see, because you'll notice when the times get tough, the room's thin. When everything looks like it's going great, oh my gosh,
A
it's
lot of
like
people.
70 people in the meeting.
Yeah,
Right
yeah,
now,
yeah,
could be 20,
yeah,
because that's what happens. You find out who are those strong swimmers when the toughs get, when things get tough.
yeah.
And those that are just like, waders and floaters that in the little inner tube that go with the current, those are the people you do not want to invest with.
Yeah. Okay. Okay. Well, I think that brings us to the end of the podcast, and actually we're out of time. But I think actually there's more questions that I wanted to ask you, just that I wouldn't have time to do it right now. So I'm definitely going to try to invite you back very quickly if you're able to. But I really want to
Absolutely.
thank you. I really want to thank you for taking the time out to share your wisdom, share your advice with us today. And I would like to, yeah. So thank you very much for coming, and I'd really like to have you back soon, if possible. Okay.
That would be great. I'd love to, Zach. It'd be awesome.
All right. Thank you.